In this set of slides, we're going to discuss cognitive biases. The first one is conservatism bias. So it's one of the first of five biases that relate to beliefs. This is a tendency to cling to one's previously held beliefs, irrationally or illogically. The belief continues to be held and justified by committing statistical, information processing, or memory errors. And this leads many people can be slow to adjust to new information. It leads to anchoring and slow adjustment. For example, companies that have earnings surprises one quarter are more likely to have a similar surprise the next quarter. They're also more likely to earn abnormally good returns for their investors, indicating people were slow to react to new information. This is an example of conservatism bias. You can see that the earnings, the blue line, is shadowed by the red line, which is the analyst's forecasts. So analysts will change their views from their forecasts slowly. The analysts maintain their forecasts even when presented with new information. The behavior observed in security analysis can logically be extended to individual investors who are likely to engage in similar behavior when managing their own investment portfolios. So people are conservative, they're slow to change. The second one is confirmation bias. So when analyzing companies, investors tend to look for information that supports their prior opinion and to underweight contrary information. So they look for and notice what confirms their own beliefs and ignore or undervalue what contradicts their beliefs. Information is considered positive if it supports their beliefs and negative if it fails to support or refutes their beliefs. One reason for confirmation bias is that it may be easier to deal with cognitively. The consequences for investors might be that they under-diversify portfolios, so they concentrate on positive information about a company and ignore negative information and information about other companies. And they build up a large position in that company and eventually end up with an undiversified portfolio. Researchers also find that it may lead to investors holding a disproportionate amount of investment in their employing company's stock because they're familiar with that company and they work for that company, they believe it has good prospects because of the feedback that they're getting from their work. And so that's positive information, and they ignore negative information about their own work. And one of the reasons for that might be that the associated mental discomfort about adding negative information about their own work may make work difficult for the employee. But it can be corrected by actively seeking out information that challenges people's beliefs and getting corroborating evidence for the investment decision. Representativeness is where judgments are based on stereotypes. People might place too much weight on a recent observation and underweight long-term averages. They believe that recent history is representative of the future. For example, recent returns, recent earnings, and growth. So they tend to classify new information based on past experiences and classifications. They derive meaning from their own experiences. When confronted with new information, they force the information into those categories even though it doesn't fit. The consequences might be that they adopt a view or a forecast based almost exclusively on new information or on a small sample. An example might be hiring or firing investment managers based on recent performance only. It can be corrected by using an asset allocation strategy to increase the likelihood of better long-term portfolio returns, or investing in a diversified portfolio. And these are some of the consequences. So representativeness may lead to excessive extrapolation. So earnestly thinking that recent performance is representative of longer-term prospects. And the result is that investors can chase past winners, so they can overreact to glamour stocks like the technology bubble. They may also overreact to bad news, which may be temporary, thus creating value opportunities. And it can create short-term momentum, but long-term reversal in returns. The illusion of control bias is a bias in which people think that they can control or influence outcomes when they cannot. It may lead to excessive trading. It may lead to investors to have poorly diversified portfolios. It's a lot like overconfidence. And one way to manage it is to keep records of your investment decision reasons. An example of illusion of control bias is that people are willing to pay a higher price to select their own numbers in a lottery game than on randomly assigned numbers. Another way to mitigate the impacts of this bias is to recognize that successful investing is a probabilistic activity. Even powerful investors have little control over the outcomes of the investments they make. It may also be advisable to seek contrary viewpoints and help logically evaluate an investment decision. Hindsight bias is where people tend to see past events as having been predictable. People tend to remember their own predictions as more accurate than they were, giving a false sense of confidence. And a question to put out there is, how many experts predicted the GFC? Not many with foresight, but in hindsight, many people have come out and said that they predicted the GFC. This may lead investors to judge fund manager performance too harshly. So people tend to remember their own predictions of the future as being more accurate than they actually were, because they're biased in the knowledge that it actually happened. When people look back, they don't actually have perfect memory. They tend to fill in the gaps as to what they prefer to believe. The consequences could be that they overestimate the degree to which they predicted an investment outcome, thus giving them the false sense of confidence. A way to manage it is to carefully record and examine good and bad investments, and in order to avoid repeating past mistakes. And also to be constantly reminded that markets move in cycles and good managers stay true to their strategies through good times and bads. So education is critical to overcome this bias. Anchoring, which is related to the conservatism bias, is where a person may be anchored to some number of value as if it has special importance. For example, your purchase price for Apple stock, or its recent high watermark, or the $2 consensus estimate for BHP's next earnings per share. They anchor you to a particular price in an investment scenario. And it can anchor you for a particular price. So in the example at the bottom, buy Apple for $120, hoping to make $30. After 3 months, Apple rises to $150, so you sell. Was that the right decision? You're anchored on the starting price of $120. It may be that Apple is valued now at $150, and perhaps there are still future capital gains to be made from that stock. But anchoring on the starting price, $120, informed your decision making. So the consequences are that you can stick too closely to original estimates when new information is learned, and it can be overcome by remembering that past prices, market levels and reputation provide little information about the investment's future potential, and thus should not influence buy and sell decisions to any great extent. So you really have to ask yourself what the reasons for the trade are. Mental accounting is where people treat one sum of money differently from another equal-sized sum of money on which a mental account the money is assigned to. This contradicts economic thought, as money is thought of as fungible, which means that it's equally well spent no matter which pot of money it comes from. So many investors place profits into a separate category or mental account than their capital. This is house money. can be lost with much less mental pain than the original capital. Dividends as income are easier to spend than capital appreciation. It may encourage investors into high-risk junk bonds because of their high yield. So basically, people categorize money, and capital gains are spent differently to income accounts that are mentally formed. And if you make money above your original investment, the house money or the profit, you can spend that more easily or even assume more risk than you would with spending the original capital. So people should recognize the drawbacks of creating discrete buckets of money. You should create a portfolio strategy that takes all assets into consideration. And they should focus on total return instead of investment income and capital appreciation. So look at the money returns in total instead of segregating them. Framing bias. So it's the notion that how a concept or problem is presented to individuals matters. For example, given a choice between portfolios A and H, where A offers a 70% chance of reaching your final financial goals, and H offers a 30% chance of reaching your financial goals, more people will choose A over H because of the positive way that A is described. So a person answers a question differently based on the way in which it is asked. And people will lose sight of the big picture and focus on one or two specific points. For example, if you're a consumer considering an automobile purchase, a car purchase might focus on style or design, but they may overlook safety features, fuel economy, and reliability. This may lead investors to misidentify risk tolerances because of how questions about risk tolerance were framed. They may become more risk-averse when presented with a gain frame of reference and more risk-seeking when presented with a loss frame of reference. This can be overcome by trying to eliminate any reference to gains and losses already incurred. Focus on the future prospects of the investment. Try to be as neutral and as open-minded as possible when interpreting investment-related situations. And finally, availability bias is where investor choices are influenced by how easily information is recalled. For example, choose an investment or fund manager based on advertising rather than thorough analysis of the options. And for this availability bias, people take a rule of thumb approach to estimating the probability of an outcome based on how easily the outcome comes to mind. Easily recalled outcomes are often perceived as being more likely than those that are harder to recall or understand. The problem is that there are biases in our memories. More recent events are much more easily remembered. The consequence might be that investors choose an investment or an investment advisor based on advertising rather than a thorough analysis of the options. They may limit their investment opportunity set to those they are familiar with. They may fail to diversify because they choose investments in a familiar industry, choose asset classes or geographic locations that they are familiar with, or choose companies that match their personal likes and dislikes. They might also overreact to market conditions like the technology bubble in the 1990s. Investors got caught up in the technology mania, causing them to disregard the risks. And people may think that events that receive heavy media attention are more important than they actually may be. It can be overcome by developing an appropriate investment policy strategy with careful research and analysis of decisions and a focus on long-term results.